what we've put on your chairs rather is the conclusions or the recommendations which came out of the research report. And what we're going to be doing is going through the first three of those topic areas. We're going to be looking at understanding the client and taking that to the next level, guiding and coaching, which was a point that Tom mentioned, and then communicating effectively. So let's take the first of those, which is understanding the client. And I think this is an interesting statistic, because what we asked people to do is to rate what they felt was most important when assessing the attributes of a fund manager. And if you look at the asset managers and the financial advisors, quite similar views. They think that the quality and transparency of controls and risk processes are the most important things. But what this illustrates actually is there's quite a big gap here when you look at the high net worth individuals themselves. And actually they're far less concerned about this, far less concerned about the process, and more about the actual individual fund manager and this key theme, which is the quality of communication. So I think
it's regulation that's driven that. The fund managers are forced to spend all their time on the other items, but the clients don't actually quite appreciate what regulation is doing for them.
I think that's absolutely right, and I think it's we do focus groups. You're looking at, for example, mass affluent, high net worth individuals looking at fund fact sheets, and they struggle to understand them, and actually the regulation is getting in the way, I think, of clarity of communication.
Communication, in that sense, for me at least,
yes,
is partly involved with involvement.
Yes.
Let me know how you're making your decisions, and let me be part of it with you.
Yes. And I think that's one of the other things which is coming through, and we're actually seeing it both across the professions, is that people want to be involved in the decision. It's a much more collaborative process. Map out options with me, but I'm not just going to take advice at face value, which is why the communication is such an important issue, and the kind of role of coaching and education. Understanding the client is so important, because wealth has changed, and it's been changed by because clients got more informed. They don't necessarily feel so confident, but they are better informed. And that, I think, is why this desire to be involved in the decision about their money is so important. All the focus groups I do, that brings out true. And I think also, as an interesting challenge, talking to the fund managers and the wealth managers, is understanding the client, because you need to understand the profitable client base. And what we're seeing is a kind of fragmentation and specialisation within the wealth industry. And so that ability to understand client needs in a sophisticated way, not just assets under management, and understanding how that's been changed, but also where you can make money, I think is a central strategic challenge. And I think another challenge is that the mechanisms within wealth management industry to do that understanding feels fairly unsophisticated. So, fact finds, for example, tend to be driven by regulatory requirements rather than really trying to get under what's motivating this individual. Does it really get to the heart of how they assess risk? My feeling is perhaps no. That's my personal experience of having been through this several times. And also looking at the client feedback and account management systems which are in place. We do lots of work amongst the law firms and accounting firms. That's an area where they've really upped their game. And my sense that we're not seeing it in the wealth industry as sophisticated. I think Coutts is different, and they've had real benefit from that. So I suppose the takeaway from this is those mechanisms for understanding your client are absolutely crucial. And clients welcome it. The sense that people don't want to be bothered, I think, is not true. So 86% of high net worth individuals state that regular client feedback is beneficial. It's a very high percentage. And I think it's looking at different mechanisms for doing that. It can be done through in-depth interviews. More and more can be done online. We've had success with that. But also using that as a basis for segmenting a client base. And Mark, it might be worth talking through your experiences of doing that and some of the benefits.
Yeah, I guess there's two sides to this in terms of some of the feedback mechanisms that we use and how it is that we segmented different client groups. First up was the research. So we used research to pay our bankers. So we changed the way that they got paid from just sheer revenue to how satisfied their clients were, how well they attended to some of the risks, and how well they got on with their colleagues. Each time we changed some of those things, that was quite interesting. So when we asked them about how they got along with their colleagues, they all cheated and said their colleagues were terrible in the vain hope that they would have a higher bonus. And they tried to do the same in terms of some of the client satisfaction scores. So they'd know a survey would go out and they'd phone their client and they'd say, go on, give me a good score. It kind of worked in that it drove contact, but sometimes it backfired. But in any case, it meant that we were getting a broader scale of review rather than just how much money they were making. In terms of the feedback that we got, it meant that we had a richer vein as to how to segment people. So Coutts segmented in a number of different ways. We certainly segmented based upon the wealth that they had. So if they were ultra high net worth, to be honest, they have a different need than those that are just normal high net worth. Sorry, there is a distinction. So they have a more sophisticated requirement. But then again, some of those people also made money in very different ways and therefore had very different risk appetites. So some were entrepreneurs. They understood how to make money. They understood about the mechanisms of what it is that they wanted and wanted to be slightly more in control. They were entertainers or sports people who were terrified that the money that they had earned was the last money they'd ever earn.
Yep.
And they had very, very different appetites to risk and how it is. And so we segmented in that way. So it meant that we could communicate them in different ways. Two of the awesome groups that we did create were around philanthropy and around family business. They have very different mentalities to an awful lot of other people. And the ability to sit down with the client and discuss with them how it is that we can help them give away all of their money was very differentiating, because normally they go in a room and say, well, they'd hear about how much more money they could be made. If you say to them, I'll help you give it away, it made them pay somewhat attention. So for us, the segments and the client research that we did were a key. There's one small point on the client research. We did surveys, we did everything. They used to present it to the board. It used to go down well, but most boards would listen to polar ends of a scale. So they'd listen to that was completely awful, or that was really, really good. And it was a problem for me because you couldn't really drive through change, because they'd only want to change that was at each end of the spectrum. So I took the board on a roadshow all around the country, and we used to do that very regularly. So this is the CEO, the MDs of sales, the FD, the risk directors, everyone. And it's just sitting down with normal clients and ask normal questions and have normal conversations. And all of a sudden it meant that the very real day-to-day issues for these clients they were just sharing them with each of the board. So no longer was it, I don't know, someone had done something absolutely fantastic, we must go and do that for the rest of the clients, even if they don't really care. It was day-to-day things that made a positive impact and that could actually be changed. And when the board was seen to be listening to clients and making decent changes that everyone really, really wanted but they weren't hearing, it has a massive impact on the rest of the organisation, because the rest of the organisation then wants to listen, can then see that listening to clients and taking actions are really, really important. And for me, I know we'll probably discuss it later, but that was the single biggest positive thing I did around some of the client feedback. Marvellous.
The other example, which I thought was interesting, is looking at the fact find, or reinventing the fact find, because I think too often this is driven by regulatory requirements, and more that can be done to really unearth what's motivations. And there's a good example here from there's an IFA network called Generic, and they used a series of different questions of getting unearthing people's risks and asking people different scenarios. And I thought quite a nice example. The other thing that they did is created a kind of lifetime cash flow as a way of forcing people to make choices about their life, and doing that with couples. So it's almost a kind of akin to therapy, if you like. So I think a lot can be done about that, and really thinking about those initial meetings and trying to unearth what the client's objectives are in a much deeper sense than perhaps is done at the moment. But I'm interested to get your views on understanding clients and the mindset.
That almost sounds like, the regulations are there to protect vulnerable people, if you like. And I think the people that you're talking about here are not quite that vulnerable and probably have got an idea themselves about what information they want to put across. So I would have thought the fact find for people like we three should really be quite easy, because you've just got to invite us into your office and invite us to tell you what we think you need to know and then ask a few missing questions. If you start on the basis of we're going to go through this checklist, we're going to get bored, you're not going to be asking the right questions, and I don't think you're going to get the right answers. But if you start on the basis of what we're trying to get to is a plan for doing the following things, then I'd have thought the facts will emerge. You know, you do have some children. You do want to give some money away. You do pay tax. I just can't help feeling that to drive it too systematically is likely to come to miss things out.
Because of regulation.
Well, but isn't the regulation to protect a different, you know, the bulk of people where you probably have to do it that way? I don't know.
The regulation is just to keep the regulators in a job.
Maybe.
There's an element to that. I thought that was quite a powerful story that you gave just now about the involvement throughout the business in the understanding the client angle. I can. Everyone's different, and you wouldn't try to sell me in the typical way. But I can certainly appreciate the power of what we've heard in terms of how people feel good about something. And it's not necessarily financial at all. So do they feel their money is doing good things? Do they feel appropriately listened to and involved? Do they feel that you've genuinely got their interests at heart? Because that's where you've got to start. And so it does sound like, as with all things, most company meetings of strategy of any kind end up with saying it's all about communication, and I think that's what you're going to do.
Yes.
So I come from a sort of regulatory background, so it's been quite interesting to see your views.
He's the one that's been insulting you.
I'm just interested in seeing, do you guys not see any sort of merit in the increased regulation on asset managers, in that you seem to be under the impression that there may be a sort of cultural issue going on here with the banks and asset managers in particular? Do you see increased regulation eventually shifting culture within asset managers?
I fear that the regulation we have at the moment is just too rigid and oppressive. I mean, if you look at the regulations that apply in other industries, like the accountants, the lawyers, the doctors, it seems to me that there's a very, very strong professional body behind it, and the fear of their disciplinary processes of being thrown out of the industry is probably what keeps people on the straight and narrow. I don't see that in fund management or wealth management, investment management industries. It just doesn't seem to be quite the same. And there's also, you know, a strong fear of shame, if you like, of being caught out in those industries. And I can't help feeling that we ought to somehow step back from very strong, very detailed central regulatory activities to more on the lines of general discipline and naming, shaming, throwing people out of the profession, so that you can generally trust people. I mean, the chart that came up here, you know, to what extent do you trust your accountant, lawyer, and so on? I suspect that the chart for doctors would be even higher, and I suspect that the chart for supermarkets, you know, where you can be poisoned if they don't give you the right food, would be even higher than doctors. So, you know, they get by with a much less regulation than seems to be imposed on us, and I think we've just got reactions to scandals being more regulation. That seems to be inappropriate.
The only people who seem to think regulations solve a problem are regulators. I think what regulators do is it's like they're trying to stop the tide going in and out. What makes the difference is what is judged. In your work, what do you get the well done for? That's the question. If you get well done by bringing a lot of money in from selling to clients, that's one thing. If you get well done for whatever else it might be, that's the key point. And so if people are determined to make money however they can by working around rules, or in the insurance business, reduce the capital they've got to hold, or in the banks, reduce the capital they've got to hold so their measures look better, they'll do everything they can to get around the regulation. And I think there's a limit to what regulation can do. What really counts is what the incentives are and what it is that's judged success in a business. And that's a very deep question.
So are you a proponent of a return to light touch regulation?
I am.
Yeah.
I would want to see heavy touch in terms of remuneration, in that I would want to see banned any form of share-based pay. No share grants or anything like that. Because what that does is tell the managers that they have some right to own part of the business. Instead of that, I'm very happy to do profit shares. I'm happy to help people buy shares in the market. But I don't want to give the signal that this business doesn't belong to the existing shareholders forever. And I don't believe you get the best people by paying the biggest sums. I think you get the greediest people are paying the biggest sums. I think the people you want are the people who really care about the business, who care about the team.
Having been
But
the
you do
finance
get
director of
such
a
business.
public company, I have to disagree with that remark. I think that share incentive schemes get you very seriously thinking about what drives value, and if you get behind it, you can really make value grow.
We
by
can
doing
agree
the
to
right things.
disagree.
Yeah.
Lovely.
The other thing which I found very fascinating by this research was the importance of this idea of guiding or coaching. So not just looking at the performance or the kind of raw advice you're getting, but the elements around it. So part of the research looked at various different kind of educational services, such as access to the firm's intranet, knowledge briefings, digital learning, access to learning or development networks and free seminars. And we asked people, high net worth individuals, would you find this beneficial? And a very high proportion said yes, they would, 79%. And that's certainly reinforced by other research we're doing. But there's a big gap here between those that saying it would be beneficial and those who say they're actually receiving it from their advisor. So I feel that this is a key point to differentiate the service, is this kind of yearning for information, because I think what we're seeing is the investor is changing and they want to feel informed before they make a decision. That's, I think, is a strong feeling, and the way in which they make their decision will be taking advice, looking online, educating themselves, and then sitting down with their advisor, mapping out the different options and then making the decision together, which is a subtle point, but I think quite an important change of mindset of the client. And so I think my recommendation is actually I think the lawyers and the accountants are kind of ahead of the curve in this respect. You look at the likes of Grant Thornton or KPMG, and they provide very sophisticated additional information. And I think I look at that, and I think that's a good model to emulate. So offering training or classes, it's an excellent business development tool, but also segmenting that by clients. With, one of the aspects here is the diversity of investors now and the millennials. And finally, when you're actually making your recommendations, and do that in a collaborative way, would be a strong conclusion.
So 85% of all high net worth individuals state that quality of communication is important when selecting their financial advisor. For me, that doesn't mean, again, come back to the hairdresser conversation or the thickness of the paper. It's about how much you listen. If I'd have sat here all evening, or for the time I was talking, telling you how fantastic I was, how clever I was for taking part in this survey, and how much I could offer you a return against some of those things, you'd think I was a terrible bore. Whereas if I'd sat here and listened to the things that maybe you'd wanted to hear, shared some tips, gave you some learning that you could go away with, maybe you think this is a worthwhile evening, and hopefully that you have. And that's what you have to do in your communication. You have to listen, you have to understand who it is you're talking to, understand what it is that they would like to hear, understand what value they would like to derive from the communications that you would give, but more importantly, in today's day and age, understand where they would like to see it. Is it in a face-to-face conversation? Is it in a seminar like this? Is it on YouTube? Is it on social media? Is it on email? There's a proliferation of channels that you can use to try and communicate to people, and quite frankly, it is bamboozling just as much as the jargon is there, he says. So some of our recommendations are keep it clear and concise. And actually this is kind of just polite. Just make sure people can understand it. And actually I should imagine across these three gents, they would probably want things in slightly different ways. I should imagine one would want it in quite a lot of detail with really long words. And some like it a little bit simpler and maybe a little less frequently. So be clear and concise and really understand how people would like it. Test the materials in advance. Now, an awful lot of people are scared to communicate because they might get it wrong. That's probably erroneous. So what you can do is just send out a small sample to a small number of people, or even better, get a bunch of people in a room and ask them what they think. Even if they tell you it's terrible, they'll actually enjoy the fact that you've asked them. So we would recommend just testing in advance, see what the response is. If it's on email, that's really easy. You can see how many people open it. If you send out newsletters, see what the responses are like. Try and track some of these things using some of the tools that you have. But for sure, just try and test it. And then finally, be more visible and be proactive. Gone are the days where you can just send out newsletters. As we found out today, people want to be involved and people want to be slightly more engaged with what it is that's going on. So make sure there's a two-way conversation around what it is that you're actually doing. And as it happens, there are a number of wealth managers using YouTube. There's a number of great ones using Facebook, ridiculously, just to pursue their brand. Some are using LinkedIn fantastically to acquire employees. There's just a whole range of different things that you can use now to make sure that your message is in front of people. And if I'm really honest, if yours isn't, somebody else's is. So you've got to kind of be in it, really.
We've had a wide-ranging discussion, but I think some strong themes have come out. I think, first of all, this need to rebuild trust. So 66% of high net worth individuals feel that does need to be rebuilt. There's been no disagreement about that, I think, in the room. That over the last 5 years, the industry has focused on regulation and cost cutting, and that has meant they've been inward-looking rather than outward-looking. And the regulation hasn't necessarily helped in terms of building those client relationships, despite the intent of that. The other thing which has emerged is quite a clear service gap. And I think the conclusion is that if you can get the service and the client understanding correct, and people feel good about their money, then the performance and the processes around that can be less important. And I think, what we're seeing is the opportunity is the growth in private wealth. But there's a big challenge here because I think new competitors are not only taking share of money, but they're recalibrating service expectations, which is perhaps the greater danger. So what we've tried to do today, I think, is map out some simple ideas which are summarised here. We've focused on just 3 of them, more in the report. So looking at ways to build understanding, looking at ways to add value in terms of educational support and coaching, and ways to make sure that you're talking in the language of the client. But I suppose, just to summarise on one final point, Mark and I were discussing, if you're going to do one thing, where would you start? And my sense is, I think this idea that Coutts had of getting clients in, talking to senior management about their expectations and what they want from their wealth managers is a great way to start, because what that begins to do is to give insight and begin to kind of force you to look outwards rather than inwards. So I just want to, sorry, yes, Tom.
Yes, can I? Right, it reminds me of, I bank with Seahor and Company, a bank that doesn't have many branches. It has one, actually. And some years ago, they started doing their own wealth management. So I asked them if I could talk to them about it to see whether it would be any use to me. And we had a discussion. What was I doing? Where were my assets? What was going on? Obviously, they could see the dividends coming in. And they said at that time, they didn't see that they could do any better, and they would charge fees, so just stay as you are.
So you trusted them?
Absolutely. That was the perfect response. Thank you very much. And I'm still banking with them, obviously, to this day.
I just want to thank you guys, because I've found it absolutely fascinating. It's been terrific, your views. I think it's really made it come alive for everyone. And I just want to thank everyone else for contributing, and for Mark as well, and the Financial Times. And thank you.